three big 8-pillar stocks. Guys, if you're one of our 12,000 people who've signed up for our software, please follow along on our software. So we're going to the 8 pillars tab. First one, Rowe Price. Guys, these guys are the retirement people. We all know that. Now, the thing about these guys is as the market declines, their fees are going to decline. So what I would do first in this company is I would go to the income statement and let's see how they did in the last big market decline. 2006, they had 1.58 and it grew and then fell a little bit and started to rebound. So the question you have to ask yourself is, did they grow because less of their fees are from asset management fees versus fixed fees? I don't know. They can add a lot of accounts. So part of your due diligence will be to figure that part out. But if you can see, their revenue has really done well in the last decade, over double, okay? So let's go back to the main page here. Just look at some high-level stuff. First off, big dividend. Now, the interesting part is their dividends paid are $1.73 billion. Their average free cash flow in the last 5 years is $1.73 billion. But last year, they did $3.3 billion. So that's good that it's about half of their free cash flow is going to dividends. It's actually a little over half. But you got to ask yourself, if the market declines further and their fees go down and their revenue goes down, what's going to happen? Or is their dividend going to be supported? I don't know. And this is a very big dividend. They could easily justify saying, yeah, we're not doing that. 5-year PE of 12.8 versus a 9.8 last year PE and a 16.9% return on invested capital. All right. Let's just go to the 8 pillars tab right now where it does all the work for you. Look at these 12.8 and 16.5 5-year PE and 5-year price of free cash flow. Shares outstanding. They bought back almost 6%. Very little debt here, guys. I love that. Because remember, guys, debt to a company is just like debt to you. The more debt you have, the more likely you're going to have financial problems. These guys are probably not going to have many financial problems. Their long-term liabilities can be paid off with less than 1 year of their 5-year free cash flow. Cash flow growth is up $3 billion. Revenue is up 2.7. Net income's up 1.3. Good stuff all around. All right. So what should we pay for Rowe Price? Let's go to the stock analyzer tool. Now remember, because I think the future for stocks is bad for the next 10 years, I'm going to make very conservative assumptions on the low side. Okay. I'm going to assume 0 revenue growth. You might be like, Paul, that's crazy. Well, if the market falls, but they add the market falls overall, but they add more and more because every month people get paid and they put money in their accounts. So I'm going to be very conservative, 0% revenue growth. That's extremely conservative. I get that. I wouldn't underwrite that myself. I'm just trying to show an example. Now let's go with 3% in the middle and 6% in the high. So it would double their revenue almost in the next 10 years. Profit margin, very healthy margins here. They're probably going to stay. Actually, I would argue that their margins might get better as time goes on because there's going to be less competition. When the market booms, there's more competition for companies like this. Let's just sit there and do 33, 35, and 37%. Free cash flow, 26, 28, and 30. PE, 13, 15, 17, 13, 15, 17. And desired return of 12.5%. We hit the analyze button. All right, guys, we got a low of around 80 to 100, a high of 170 to 207, and a middle of 120 to 140. Look at this, guys. The stock's currently at 108. So if you want to be conservative, put 105.6, add it to your watch list so you get notified when it hits there. But this is a company you'll want to do more due diligence on for sure. Please do it. This is a great company. Please make sure you like what you read before you make a decision. Stock number 2, Fox. So Fox, 8 pillars. Let's go right here to Fox. Now this company includes the assets that were not sold to Disney, which includes 21st Century Fox, Fox News, Fox Broadcast Network, FS1, Fox Business, Big Ten Network, and a bunch of other affiliate stations. So it's a lot of stuff. Let's look at their income statement. $7.8 billion to $14 billion. Now, this is going to be banking a lot on people wanting to watch live news and sports. So overall, I like that because how you can get more advertising dollars now, it's through sports. Why? Because you can't pause. Nobody's pausing sports. Nobody's watching sports later. They're watching it live. Same with the news. The high of $40 a share, 52-week low is 29. It's currently there right now. Let's go right to the 8 pillars tab. Guys, all 8 check marks. 11 times PE, 10 times price of free cash flow. Shares outstanding, they bought back 5%. Debt is reasonable. Cash flow growth, They have a dividend yield of 3.1% that pays out $440 million. And in the last 5 years, they've averaged $1.8 billion in free cash flow. And last year, 1.38. So they can easily afford that dividend. So the question becomes, what do you pay for this company? Stock analyzer tool. Now, let's go with revenue growth. Again, my goal is to be conservative. I'm going to go with 2, 4, and 6%. Profit margin, I'm just going to keep 7, 8, and 9. Free cash flow margin, I'm going to do 7, 8, and 9. PE, 13, 15, 17, 13, 15, 17, which is way higher than it is today. And our desired return of 12.5% for the same reasons before. Margin of safety, and might as well, you can get an ETF for 9 or 10%. Get yourself some reason to buy. All right, so even with this, the high, even with it selling so low, the high here of $36 a share, it's there. Now for the middle and the low, you're at 19 to 26 bucks. So I'm going to add this at my watch list of 26.34. Notify me. I'm just going to pay attention to this. I looked at the options for this company yesterday. They were garbage. I don't know why, because it's such a big company. I mean, what's the market cap of this company? 18 billion. And the options were just garbage. So I can't just sell like future options, much, much lower prices. But either way, this is a great company to look at. Company number 3, Meta. Meta is Facebook, but now it's called Meta Platforms. And their ticker symbol is now META. Current price is 165. And that's, yesterday, I think it hit the low of 161. And it had a high of 384 for the year. Okay, no dividend, but a really high return on invested capital of 16%. A 5-year PE of 14.6 and a 1-year PE of 10. So everybody's upset with Meta because, they have no growth potential left. Well, yeah, because everybody in the world uses Facebook or Instagram or WhatsApp or something. I think they have 3.4 billion active monthly users across their platform. There are 7.5 billion people in this world. How many of them don't even have computers? There's still a lot of growth potential on a per user basis for revenue. So that's my idea about Facebook, about Meta. Let's go to the 8 pillars tab. They're buying back almost 6% of their shares. Very, very little. I think they actually have more cash on hand than all liabilities. A price to free cash flow of 15.5 and a price PE ratio of 14.5. Everything's great here. Let's look at their revenue growth. I just want to show you this. Look at this. 10 years ago, 4.6 billion. Last year, 120. The profit is the big thing here too. $67 million in profit 10 years ago, 37 billion now. Guys, you know what this means? Do the math here. They make about $700 million a week. 10 years ago, they made $67 million the entire year. They make more in a day than they made in the entire year 10 years ago. When you see the stock analyzer tool, I want you to understand that this is why we created the software. There were so many issues I had when trying to determine what to buy for how to buy a company. It's easy to use 1-year numbers, but that didn't work. I want to sit there and create some sort of way of organizing all my data so I can do all my research. And then when I'm done with my research, I can input my assumptions in the stock analyzer tool to tell me if I'm in the ballpark of what to look at. That's why the software was created. If you look at our early videos, I used an Excel sheet. And everybody, all our viewers would say, how do I get the Excel sheet? So I made it. And 12,000 people since then have signed up. They're involved in this entire community here where they're active, talking about so many different things, including crypto, Tesla, value plays, day trading, swing trading, everything you can imagine. I do daily quotes. We put daily videos up where we sit there and give exclusive content just for our users. We have exclusive seminars just for our users. We created this in order to make everybody a better investor. It has all of these tools right here. The retirement calculator, stock analyzer tool, which you saw, 8 pillars portfolio where you can put your entire portfolio into this and it'll tell you how it looks. Exclusive video content I told you about, but watch list. You saw me put the watch list in there. You get a company, you find the price you like, you hit the check, you hit the plus mark, it'll put it in your watch list and notify you when it hits there. Guys, this is a no-brainer. And this software is available for less than a cup of coffee per day. And if this can increase your returns by 1 or 2%, or decrease your losses, because we're the same people who said avoid Peloton, Palantir, Workhorse, Neo, all these companies that went and dropped 70, 80, 90%. This pays for itself in a matter of months. This could lead to hundreds of thousands, if not millions of dollars extra in retirement. 2 ways to sign up, everythingmoney.com, or for our international users, patreon.com. Sign up now, less than a cup of coffee per day. Thank you very much. All right, so let's go to the stock analyzer tool. So even though the revenue growth was huge in the last 10 years, I'm not going to assume that going forward. I'm still going to assume good revenue growth, but not huge. I'm going to go with 4. I'm going to go with 3, 5, and 7. Profit margin, 30, 31, 32. Free cash flow, I'm going to do the exact same thing. PE, 13, 15, 17. 13, 15, and 17. And there is still some unknowns here. So I'm going to go with 15% return. Analyze button. Look at this, guys. Low end of 131, high end of 211. The middle is 166. Monish, in our interview with him back in December, Monish Pabrai, said that he thinks Facebook is an easy double. And that was back in December. Or maybe it was with us. I think it was. But the point is, Monish thinks that. Now, don't go buying it because Monish Pabrai says it. Go do your own research. Go understand what you're buying. But this could have future potential.